lesson 3 in our supply and demand course, and this is probably going to be one of the most important videos when it comes to analyzing price action and how to properly navigate the markets through supply and demand. So before we start, we gotta have a bit of context and answer some questions. So how the market truly moves is that it is a constant auctioning process where price can either be imbalance or balance. So whenever you see that the market's bouncing back and forth and consolidating, that signals that price is in balance because that's where the most trading activity and volume is being conducted, right? But the market doesn't stay in balance forever because there are certain news events or catalysts or something happens in the world that gets shown on the chart that leads it to become imbalanced. And when price becomes imbalanced, that's when you get those big trending days, either to the upside or to the downside. And throughout all of that, what you see on the charts is pretty much a translation of that auctioning process, right? And one of the most important things that we gotta pay attention to is who gets trapped when we're trading the market, because you don't want to be a buyer that's getting and the chart is getting set up to trap you, because obviously if you're wanting price to go up and you're buying at a spot where you're very vulnerable and you end up getting stopped out, that's exactly why a lot of traders are struggling in the markets. So in this lesson we're going to be talking about how to see and explain why buyers and sellers are getting trapped through all these different market structure concepts like liquidity, breakup structure, and more importantly, the flip zone. And that's a supply and demand concept. But the liquidity and breakup structure, that is stuff that people have just discovered by analyzing the science of the candlesticks. So first off, we have liquidity. And what liquidity is essentially is a good analogy is that it's fuel. It's fuel for price to gravitate towards, because that is where these big banks and institutions and big orders can unload. So if we're talking, let's just use an example. Let's just say we're a hedge fund and our budget or all of our order sizes, they happen to be 1,000 lots, right? And for every buyer, there needs to be a seller. And these hedge funds, they can't just unload a 1,000 lot order all at a single price level, right? So what happens is that they do it several ways. Either there's several price levels that they decide to unload it at, or what happens is that they find a price level with lots of sellers, right? And usually what happens is that price moves in such a way where it happens to leave a footprint where at a certain level they do have that quantity of opposing orders that they're looking for. Let's say a hedge fund is long all the way down here. They have 1,000 lots that they're trying to unload. They can't just unload 1,000 lots here at, let's say this is $25 and this over here is $30. They can't just unload all their orders at $25 if there's only let's say 500 sellers here, right? But if for some reason, and we're going to explain those reasons on why there could be more liquidity or people sitting at the dirty price level, if there happens to be 1,000 sellers sitting at this level, when they have a $1,000 lot size or 1,000 order lot size, price is going to gravitate towards this spot, and this is where they're going to unload their orders. But price needs to accumulate this amount of sellers first, right? So the way they do that is they start trapping a lot of people by convincing them to go short around this price level. So when they're all going short around this price level, um, this hedge fund is waiting for price to enter at a solid price level where they're willing to buy 1,000 lots, and then they're gonna unload their orders at these liquidity levels, and these can happen at swing highs, double tops, double bottoms. Like there's all these different patterns that you see that leave behind signs and hints of like, oh, maybe this is where price wants to go, so that way these guys can unload their orders, right? And these guys are the ones that have access to all the they have better information than retail traders, because the one of the ICT concepts is that you're trading it's retail traders versus big banks and institutions. And the reason why these big banks and institutions win is because they always have insider info, or they have these guys that they hire for hundreds of thousands of dollars to study the way the market moves, and so that they can get the edge and get the best price to buy and sell at before everyone else. And these retail traders, we don't have that. We don't have access to these $1,000 per month terminals that they use, that they can get news literally the second it gets released. That's not something that retail traders have. And that's why it's a constant battle between retail traders and big banks and institutions when it comes to liquidity. So these levels that have liquidity, it's essentially spots for these guys to unload their orders. And additionally, the reason why there's 1,000 sellers here is because let's say price makes a pattern, and for whatever reason these guys are thinking, oh, it's a trending move down, and then a fair value gap gets created, and that's like their entry model, right? There's all these, like, whatever entry model they use, whether it's like indicators or price action or something entices them to sell right here, right? So now you have all these sellers here that are involved in a trade, right? And because these guys are involved in a trade, these guys essentially become liquidity. And because these guys become liquidity, now these guys can become targets for the big dogs to either sell or buy their order back. So yeah, that's why liquidity is important, and there's plenty of ways to find like what is the real liquidity pool or target. There's plenty of ways to do it, but the main thing you want to get is that this is essentially where price wants to go when the market is in balance, because that's where they can unload the most orders. So another way that buyers and sellers can become trapped is if they're on the wrong side of liquidity, or they become liquidity. So if price wants to go to, let's say, 35 bucks. Actually, I'll just draw this. If price wants to go to 35 bucks and you're sitting short at $30, you want price to hit like $25 if you're a seller, because you want to profit the difference of this. But you can become liquidity if there are more people buying at $25 than there are people selling, right? So if price never reaches $25 and it ends up going up before you hit your take profit, now you're forced to cover. Because you're selling, you have to buy to cover, because you can't just let price go back on you forever. Like if you're a seller, your stop loss is a buy order. And that's what buying to cover means. And your take profit is essentially buying back the future that you're working with, or whatever product you're working with, at a cheaper price, and then you pocket the difference, right? So that's why when price hits your stop loss, price actually ends up going higher because your buy order is being sold to someone else. So even though you're a seller, price can still go up after it hits your stop loss because you're buying the cover, and that buy order makes it so there's another buyer at this price level. So when you become a buyer, price will want to continue lifting up, and that's how you become liquidity. That's what being liquidity means. It means they take your stop loss and they use it to make profit on your trade. That's why you don't want to be on the wrong side. You want to be the guy that takes profit when someone else is buying, and they're buying at a worse price than you, because you want to be the guy that price wants to hit $25, and it does hit $25, because then that means your order is getting filled, you're taking profit. You don't want to be on the opposite side. If price actually wants to hit $35 and you're a seller at 30, then you just lost $5, right? So that's the whole concept of liquidity right there. So hopefully that makes sense. All right, I'm gonna clear all this out. Okay. So that's one topic down, and then the next one is break of structure. So a break of structure is candlestick signs, all right? So this is like unrelated to supply and demand for now. Break of structure is the way the market moves. So when the market moves, it prints these candlesticks, right? And when it prints these candlesticks, it pretty much creates like these movements that you can track. And then, you know, there's different terminologies for this. Like this is a swing high. Okay. I don't want to... Actually, yeah, I'll just abbreviate it. So swing high is SH. Swing low is SL. Swing high. Swing low. And people pretty much just like analyze the candlestick patterns to see what is the pattern that they create. And essentially, this is the structure, and they coined it where if price is trending up, where it's constantly making higher highs and higher lows, that means price is trending to the upside. And when price is trending, there's two ways that price can move. It can move trending / impulsively, where it's just strong moves up to the upside, or it can also move correctively, where it's just very like deep pullbacks and pretty much moving a lot more movement and to the downside, and it's not as strong. Actually, let me redraw this. This is not a good example. So if price is moving to the upside very strongly and trendingly, there's shallow pullbacks, like this barely crosses 50%, like this is just 25% pullbacks, that means price is trending, because price doesn't want to do a deep retrace like this, where it seems like price is consolidating, like yeah, so this is like a corrective move where it's like, you know, you don't really know what's happening. There's really deep retracements, and there's no clear direction. That's essentially what corrective means. Corrective means there's no clear direction, and it's like the counter move. Like this big move to the upside, that's impulsive. That's trending. That's trending / impulsive. This move to the downside right here, it's tiny. In the grand scheme of things, price is still going up, but this minor pullback, that's a corrective move, right? It's just going back down slightly, taking some more orders. It's like finding fuel. It's finding fuel so it can continue going up. There's like when this is going down, people are probably thinking, oh, maybe there's a price is reversing here, but that's not the case. What's happening is that is finding more fuel for the bigger move up, essentially. So it might be better if we go in the charts so you can actually see what I'm talking about. But yeah, that's like the concept of it. So when you get a break of structure is essentially saying that prices reversing on that specific part or a section of the candlesticks. So let's say we have a strong move up. Okay. Like none of these swing lows are being taken. All these swing lows are being protected. That means this section right here is trending to the upside. Okay. A break of structure means that this strong move to the upside is being broken. It gets broken by price in crossing this swing low and then creating a lower swing high. So this is just market structure. This is like candlestick analysis. Because now when you see something like this, you don't think it's a strong move to the upside anymore. You're thinking, oh, maybe price reversed because this swing low, its structure got invalidated by price crossing it, right? So now this doesn't look like a strong move to the upside anymore. Now it looks like there's some sort of reversal and maybe price movement has changed. So that's what a break of structure is, essentially. It's just changing the structure of the way that the candlesticks are moving right now. So I'm gonna go in the charts because I feel like that would actually be a lot easier to explain. So, like, let's say right here, we follow this. You see higher swing lows, and then you see a really strong move up, right? This is what I'm saying. Like, this section here, you're thinking price is bullish, right? Because there's a strong move up. You see a strong move up, and you see higher swing lows, higher swing highs for the most part. It's not perfect, but you're essentially seeing an upwards movement, all right? But as you're tracking all these swing lows, so you can see one right here, see one right here. You're tracking all these swing lows during the moment, like your long position is pretty much protected as long as these swing lows are also protected. Because if price is trending one direction up, should you expect your entry right here to be taken if price is having a strong move up? You see signs that price is continuing to move up in a very strong fashion. You should not be worried about it hitting your stop loss. Because if you're in a long position, you're expecting price is going to keep on going. Because if you look at the structure, you're seeing signs that price is bullish to the upside, or because of the impulsive nature of these candlesticks, right? Like, so then you track these swing lows, and then you see all of a sudden price reverses. When price reverses, it takes out the swing low with a candle. And now you're thinking, oh, maybe price isn't bullish anymore, all right? That's candlestick signs. So now in this leg, now you see bearish movement. That right there is what that break of structure signifies. It signifies a change in the nature of price. Maybe at one point it was bullish in this leg and that's how you would study it, that's how you would review it. But the moment price decides to invalidate this swing low, now you have more evidence. This is essentially all trading is. What trading is that you're gathering these evidence and context for your trade idea. This is why I offer so many different ways to look at the market. Ultimately, you still got to look at supply and demand. But all these different things, what you're looking at is you're gathering all these pieces of evidence that confirm your thesis that price wants to go a specific direction. So when I see something like this, like my first piece, like if I'm trying to set up a short trade, all right, I'm watching price. I see price is currently bullish. It's trending to the upside. What evidence do I have to enter short? I have nothing. Nothing yet. So then I wait. Oh, wait. Boom. breakup structure happens. Okay, that's one piece of the puzzle. I have a breakup structure. Okay, now we wait more. Okay, like a breakup structure alone isn't enough to be like, oh, we're going short. We need more evidence. So we wait. Okay, 1 minute demand. It gets filled. It looks like it's almost gonna work, but then, oh, wait a minute. Look at what happens. Another breakup structure, and then new supply prints. Drop, base, drop. And we also had evidence that there was a buyer here. Rally, base, rally. Okay? We had evidence that there was a buyer here. The buyer failed to keep this uptrend in price. So now, what evidence do we have for this short trade? Okay? Now we have buyer evidence failed to bring price higher up, and then new supply / sellers come in, price retest the supply zone, sellers filled, more. Now this is all the evidence we have for our short trade right here. The moment this happens, this is why breakup structure is important. It's literally just another piece of evidence when you're crafting your trade ideas, okay? So we had a buyer here. A flip zone gets printed. This seller traps this buyer. That is what happens. This buyer had its chance to take over and bring price higher up. Because it failed, it gave us the evidence and context that price wants to go lower. That is your high probability short trade right there. That's why this is all important. When you combine all this context together, that's how you get these high probability trades where it's not just guessing or it's not just luck, it's not gambling, it's none of that. Because you're waiting for that perfect opportunity that you can join in. Now, it's very, sometimes you won't get this perfect opportunity where you see a breakup structure and then you see a new supply zone print and then you saw a demand zone get flipped, buyers get trapped. You don't see all that all the time, but when it does happen, that is your chance right there to load the boat. This can become an entry model. This can just become another way you determine directionality for your trade and then enter your own entry model. Like, just understanding how the market moves is essentially, this is just how you're going to be able to profitably trade the market, all right? And then liquidity, now that you're a seller, okay, let's say you entered right here. This is where I entered today. How would you know where you want to take profit, all right? That's why the next thing you look at is liquidity, okay? You're looking for that poor buyer that wants to buy at a price where they think it's going to go up, when realistically you know that with all your evidence and context, that price wants to continue lower. You're going to look for a spot where they would want to buy it, so that way you can sell, or you can buy back your sell order, right? So you look around, honestly, you would literally just look at a spot where maybe a double bottom could have been created. Like this right here, this could have been a great spot just to take profit. Like, imagine how much buyers are right here that are still in their trade, because at this spot here, it's been protected all this time. There's been multiple attempts. Like, there are probably more buyers entering right here. Their stop loss is down here at a swing low. That's just how most strategies work. They just have it at a swing low. So now there's probably plenty of orders right there. Boom. Let's say you decided to hold it all the way down there, or maybe you don't. Maybe just like, there's liquidity everywhere. There could literally be liquidity at all these swing lows. But when you're trading and you want to get those big targets or big take profits, you're just looking for the spot that has the most liquidity. Because the spot that has the highest magnitude or the highest amount of liquidity, that's probably where price is ultimately going to go. Like, yeah, sure, price can go here. They can probably go at all of these. But the spot where the most people are at, that's probably where price is most probably going to go as well. So So, oh. So yeah, to wrap it all up, this is literally just a game of buying and selling alongside these big institutions that have the power to move the markets or leave behind the footprint of where they bought and sold. That is what supply and demand is. These zones that get printed on your chart, it's pretty much just telling you the footprint of where they're at. Like at this specific spot, there was a chance that there was an imbalance of sellers right here compared to buyers. This is them selling at, let's say, 100 lots right here, and they couldn't get all of it filled. Maybe only 50 of them got filled here, right? But because all these buyers got trapped, you use all your context, you use all your evidence, you're thinking that there's still more sell orders right here that haven't been all been filled. So when price comes back to it, that's your chance to join these guys. There is a big banking institution right here at this price level, and if you're playing and trading along with them, you will be profitable because they probably have some sort of clue on where price wants to go. So by joining them, you are trading with that extra probability that they also have. They're using they have some sort of advantage over us retail traders. And by being able to join these guys in their trades, you are able to profit with them. You're not going to be that guy guessing whether price wants to buy or go up or down with no information. No, you're trading with these guys. So, yeah. It's pretty much all I got. And then, yeah, liquidity. Again, it's just a spot where price wants to go. So now these guys can unload their orders because for every buyer there needs to be a seller. So they can't just target somewhere where no one wants to buy if they're a seller, right? They have to sell they have to sell at a spot that people are willing to buy. And that's why the concept of liquidity exists. There's different ways to spot it. Breakup structure is essentially how price moves, and then when you see one clear direction and you track the market structure and these swing lows and swing highs, seeing prices cut through them, that is a breakup structure. And again, you see plenty of these on the chart. I'm gonna go back to the charts. Like you see one here, you see one right here at that swing low, see one here, and then like this swing high gets protected. Oh, look, like right here, swing high, it gets invalidated here. Oh, swing high also gets invalidated here. So now you're probably thinking, oh, price is bullish, right? But that's another trap that they put in this leg here. How many people do you think thought price was going to be bullish when meanwhile you knew this entire time that price wanted to keep on going lower? So they get all these people to buy, right? And now all these people that are buying, there is one guy that knows price is going to go down, and he's selling to all these guys. He's selling all his orders to these buyers all up on this leg here. And now he has a 200 lot. Now he has a 200 lot sell position, and now he's gonna fucking price is ultimately gonna go down, and now he gets to take profit with his sell position. Meanwhile, all these guys that thought price was bullish because there's a bullish fair value gap or there's a breakup structure, these guys are all trapped. These guys are buyers. When price is going down, they have to sell back. They have to sell back at a loss to get their ass out of the trade. And ultimately, them selling back at a loss is more fuel for price to continue going down. So yeah, that is the idea of breaks of structure. It can be used as a trap, or it can be used as evidence for your trading idea. So, and then flip zones. Again, flip zones are just zones that get created that, again, I mean, it's pretty self-explanatory. They flip the opposing zone. So like, let's say this is a demand zone right here. A flip zone is this leg that invalidates this demand zone, but then also prints new supply as a result. So this is a 1 minute supply zone. That, or the real technical term would be a 1 minute flip zone. Because new sellers entered, these buyers are trapped, they get flipped by supply zone. Like that could be an entry model. Again, plenty of ways you can use this in your analysis, but and entry models, directional bias, that's just a few to name top of my head. And then yeah, I mean that's essentially the whole thing. You got any questions?
So, how do we avoid getting trapped as a retail trader?
Okay, so yeah, that's a good question because I forgot to mention the only reason why these flip zones work, because if you look at a price chart, there are plenty of flip zones that get created that don't work, and the reason why they don't work is because they're in fair value. So this whole section here, this is all fair value, and that's why when price was up here, this flip zone got created. This buyer was trapped because he was buying when prices were expensive. Price always wants to gravitate towards fair value because this is where the most orders are, and this is just yeah, it's just a magnet for price. So when these new sellers stepped up above fair value, this flip zone worked really well because fair value was below where price was currently trading at. So to avoid getting trapped is essentially just avoiding the area where the most trading volume occurs because you don't really know, because price is in balance here. Supply and demand is a strategy that works when price is imbalanced. Price is imbalanced when it's outside of fair value. So you could probably see 1,000 flip zones in here, and realistically, they would all fail in the grand scheme of things. Maybe you might have been able to take profit or whatever, but in the grand scheme of things, they are designed to fail. Any zone, whether it's a flip zone or a supply zone or a demand zone, they're designed to fail inside this area of fair value, inside this choppy action of back and forth. Flip zones work the best, and zones in general work the best outside of fair value. And at the end of the day, supply and demand still is like a retail trading strategy. Like it it gives you an edge on the markets, but again, there's so many different time frames. There's like the 1 minute, 2 minute, 3 minute, and supply and demand zones. They appear on all of these, so you don't really know for sure whether the zone that you're looking at is the zone where the institutions left their footprint on the chart, right? Every trade that you make, sometimes you're gonna get trapped, but the goal is you're trapped less times than others. And when you are on the right side where you did pick the right zones, you make enough money where the winners outweigh the losers.
Makes sense to me.
Yeah, I mean, it all ties back to supply and demand at the end of the day. Just trade outside
Yeah,
of
so
fair
basically
value.
just fair value. Yeah, fair value is just dog shit.
Mm-hmm.
And yeah, just being risky if you're trading while in there.
Yeah. So
So, um, now that makes sense. Should be a good video.
Yeah, so you comprehended all that? No other questions?
I'm trying to think of like what, like, so when buyers or sellers get trapped, it's because most like, well, it's institutional money that is trapping them. No.
Yeah, essentially. It's the market makers, the ones that like actually move the markets. Those guys are the ones trapping them.
Okay. So the reason they're trapping them is so they can get their orders in at a more cost-effective way, right? So
Yes.
like they get a better price.
Yes. They always want the better price. They don't want to buy and sell at the price that everyone else is buying and selling at because that's where they make the least amount of money. When you're an institution, you're trying to make the most money, so you're trying to get the most cost-effective price constantly.
Okay, so say there is the market movers
Okay.
are know the price are going down.
Okay.
And so they're trying to get a better price. Are they placing buy orders to bring those prices back to show that it like kind of trick other traders like to say, oh, it's bullish now, even though they have those orders placed up top because they want to to short it down to the ground? Or so are they placing more orders like as well? Or like how do I explain that? Like are market movers placing orders to trick the buyers into also following the same orders they are placing, even though they have a much bigger lot of orders that are going to do the opposite of what? God, I don't know how to explain this. It's
I
a
know what you're
question.
saying. So, okay, so it gets a bit complicated because market makers, their whole thing, they're not really they're causing price to move, but the how they're getting price to move is by putting more orders in the market. They want as much people putting in as much money as possible into the markets. So they're always like price is always gonna appear like there's a trading opportunity, and that's essentially what the market makers do. They just move the candles enough where for whatever reason people just want to join in on the trade, right? And there's all these different stuff that could happen, but ultimately these market makers are like providing they're also providing liquidity themselves so people join in on the trade. But these market makers, they're also market makers don't necessarily trade with the intent on making money. They're trading with the intent on creating volume. It's these big banks and institutions that are the ones that want the cost effective stuff because with all this liquidity and volume inside the markets, they want to find the prices that are the best for them. Like, because these hedge funds and stuff, they're the ones trying to make the most amount of money and profit from this. Market makers, they could kind of be indifferent to it. Their whole goal is just to like move price around so that way people buy and sell. That's what their goal is. They're not really trying to make money. It's the it's the people of huge order sizes that are trying to trade for a profit that are the ones trying to get the cost effective stuff, and they're also the ones that want buyers and sellers to be trapped, and their lot sizes are big enough where they can trap buyers or sellers at the right price level because there's just so much orders there that the person on the opposing side of the trade, they're not able to um, they're not able to break that like wall essentially. Like I don't know if that last part made sense, but
Yeah, I'm just trying to visualize it. Like,
I'm gonna type it out. Market makers, they move price with the intent of um, adding trading volume. Big banks and institutions trade for a profit with large size. That's literally the main. That's honestly the main similarity. They both trade with large size, but their intent is totally different.
So market makers are completely different entities than the institutions.
Yeah.
And the market makers are the ones trapping the sellers and buyers.
Um.
And the big banks profit off that, no? Or
Yeah.
is it kind of
Kind of,
both?
because they're not working together, I'd say. But the way that they trade, they happen to look like they're working together, right? So with all the volume that gets put in, so here, let's just create an example here. So let's say there's a demand zone right here, and there's a supply zone right here. Okay. The market maker's job right here is just to get price moving, like go around, because as price is moving around, there's people that are watching as they're watching price move around, and they're thinking, oh, this is a good opportunity to join the trade, right? So these market makers, they're like just moving price around, and then these people join in on the trade, right? Now these big banks and institutions, these guys are the ones that know that when price gets to this point, they should buy because they know that maybe like earnings reports are going to be good, or maybe uh, Tesla is about to release a fucking new robot. They know something. Whatever they know, they decide that they're going to buy right here. Or maybe they already bought right here. Maybe they want to have more buy orders here. Whatever. The point is they're buying right here. Okay? At this price level. When they buy at that price level, they're buying because they know it's the best price. They know that the product that they're trading is undervalued because of the information that they have. So, with all these people that have entered the trade that don't know that the product is undervalued, these banks and institutions, they're able to trade profitably. So the market makers don't intentionally help out these big banks and institutions by trapping all these guys. What's happening is that these buyers or these trading guys, the people that enter the trade, they trap themselves by involving themselves in the market with no edge, right? And that's why that's why it seems like they're working together when realistically they're not working together. What's happening is that these big banks and institutions, they just know that this price is good, and that's why people end up getting trapped, because the people who sold when prices are overvalued, or when they sold at a price that was just undervalued and bad, they're on the wrong side of the trade. But that's because they didn't know that they were selling when the product was undervalued, and as a result, it looks like these two are like collaborating with each other. But realistically, these guys are just always trading at a profitable price because they have some sort of edge over the markets and these other traders because of information that they have. And these market makers fuck over the guys that enter the trade because because something enticed them to join the trade. Like, they didn't intentionally want to trap these buyers and sellers. It just happened that they did get trapped. Does that make sense?
Yeah.
Yeah, it's a lot to it's a lot to comprehend and digest, especially with all the other stuff that I was talking about earlier. But
So visualizing it is like, hold on. So it's kind of like, so there will be a continuation or like a trend,
okay,
and people are going to want to hop on that trend
okay,
and follow it down, right?
yep,
And once the um I guess whoever is trapping them or the institutions or market makers are seeing this, they are able to place orders in that force those trend hoppers, or I guess you could say people who don't have the edge and they're just following the trend, to buy back their order at a loss.
yep,
So that's the trap. So it's hitting their stop loss. It's
yes,
causing the trend the trending people or the trending orders to hit their stop loss. And then along with that, they also get a better price. I think.
yeah. So
I'm trying to think.
yeah, okay, I'll let you think.
Dude, it's like this one doesn't click for me for some reason.
Nah. Let me see if I can re. Okay, so let's say you're a
Like
seller.
how, like maybe it's like visualizing it in the market. Maybe I don't understand.
Yeah. Okay, so you're a seller here. This is your take profit. This is also a buy order. I see where the mix-up is happening. So boom, and then stop loss. This is also a buy order, and then you're as a seller you're placing a sell order. Okay. So these, when you're a seller, you place a market order that is a sell, right? So you're placing a sell order right here, okay? The way you make profit
Yeah.
when price goes down is by buying back your product. Because if you sell at $25, okay, and you buy back your product at 20, you are profiting the $5 difference. Okay? And then when
Yeah.
when price hits your stop loss, you have to buy back your product that you sold at 25 for 30. So this is a minus $5 difference.
Okay. Yeah, I get that.
Okay, right? And this buy order right here, if you're buying right here, that is what um that is what causes price to continue going up, because if you're a buyer right here, okay, what the fuck? If you're a buyer right here, this is what causes price to continue going up, because if there's more buyers than sellers at this specific price point, price has to go up, right?
Yeah.
And yeah, even though you're a seller right here at this price point, when it hits your stop loss, you are now a buyer because you're buying back your sell order. And that counts as an order for price to continue going up.
Oh, so okay. So when the market is trapping those sellers, it's pushing the market in the opposite way of what they intended to do.
Yes, exactly.
So so they put in those orders to kind of create a manipulation that the market is going back to being bullish, even though everyone was quote unquote bearish.
Yeah, essentially. Like that is how people get trapped. When all these stop losses turn into buy orders and it turns into a big squeeze where initially price was going down a lot, but because all these sellers get stopped out of their trade, they become buyers, and because they become buyers, price continues going in the opposite direction of all these sellers that are maybe still in their trade, right? So,
Oh, that's what. Okay, that makes much more sense now.
yes,
So they're trapped because yeah. Okay.
because price is going the opposite direction of where they
Yeah.
sold.
Yeah.
So that's why the market is constantly trying to trap people because they're trying to get people to be on the wrong side, and then it creates more fuel for the markets to move in a certain direction.
Yeah. So it's like constant trapping.
Yes.
It's much more simple than I was thinking.
Yeah.
Okay. Yeah. So yeah, the market makers or the institutions are just putting in. I gotta stop thinking about that. It's just like they're putting in orders that are creating other stop losses to get hit. So then price moves up. So they're not really, I guess, it's an easier way to move the market as well.
Yeah. Because the market needs fuel to move. Liquidity is that
Hmm.
fuel that it's looking for. That's why the market is constantly searching out for liquidity so it can move the markets. Otherwise, there'd be no
And
trading
liquidity
activity.
is, yeah, liquidity is just when a buyer has a seller, no?
Liquidity is literally just a trade, a buy or sell order. It's just trading. It's just like a limit order or like a spot where there is an order essentially.
So when people say like liquidity sweeps and stuff like that, like what does that look like?
Liquidity sweep is just like a spot. Like let's say there's a lot of liquidity at this area right here. Like let's say there's sellers here,
Okay, so
or fuck, there's buyers here. There's buyers here. There's buyers here, right? For whatever reason, they thought price was gonna be bullish. Because there's a swing low here, a lot of trading strategies say that you should put your stop loss at a swing low. So this is where a lot of sell orders are, right? Because
okay.
if you're a buyer, then you have a buy order um, as your position, and your plan is to sell. Your plan is to sell if price hits your stop loss. Your plan is to sell if price hits your take profit, right? So
Yep.
liquidity sweep is essentially where a lot of orders are, right? And in this case, it comes in the form of stop losses. These sell orders are just stop losses of these buyers. So a liquidity sweep is essentially when price visits this area, takes all the liquidity, and then it ends up like reversing in the opposite direction. It uses these sell orders
Okay.
as fuel for these um, for like buyers to buy buy at this price level and then shoot up. Like it's just fuel. Just yeah, I would think of it as fuel where it's like the market's like it's like a fire where to keep on burning and moving, it needs fuel. It doesn't just go off of nothing. So it needs people. It needs people to continue going to wherever it wants to go. Because if
Okay,
these
that makes a
buyers
bit more
want price
sense.
to go up, they need a seller to sell a position back to them, right? These buyers can't join in the trade if price never hits their price level. So that's why there's like liquidity, there's sweeps, all that stuff.
Okay, yeah. Makes sense.
Yeah.
Oh,
So yeah, is the concept a lot more like At least like comprehensible, I guess.
No, yeah, it makes sense.
Okay. Yeah, I think that's a solid spot to end the video.